Today, we find ourselves in the golden state of California, where a collapsing investment bank may provide an arbitrager, one with an iron will and ice running through their veins, with the opportunity to make a huge profit, or possibly a significant loss. You've probably already guessed we're looking at B. Riley Financial, the California investment bank established by Bryant Riley. Bryant founded the company in 1997 to provide research on small companies. The company grew at a rapid pace, and by 2003 was involved in investment banking. This position was cemented by the acquisition of Friend & Co., a boutique investment bank. Emboldened by the success of this deal, Riley continued buying companies at a rapid pace. 2012 saw the purchase of Caris & Co., a stock research firm. In 2014, Great American Group, a specialist liquidation provider, was bought. This deal provided Riley with a listing on the OTC Bulletin Board, which was upgraded to a NASDAQ listing in 2015. The buyouts continued. FBR & Co. was purchased for $160 million in 2017, and later that same year, Wunderlich Securities was added for $67 million. 2018 saw the addition of Glass Ratner Advisory and Capital Group, and a 49% stake in broker-dealer National Holdings Corp. The remaining 51% was purchased in 2021. After this frenetic deal-making, Riley Financial became a member of the S&P 600 index in 2021, with a share price in excess of $72. However, as we learned with the chorus, when you fly too close to the sun, you set yourself up for a fall. In 2023, Wolfpack Research, the activist short seller, announced it held a short position in Riley Financial. It released a report that criticized the company, stating that during the everything bubble period of 2020 to 2021, Riley Financial had over-leveraged to buy speculative assets and lent money to companies that have a high probability of defaulting. By November 2023, the wings have fallen. Riley Financial disclosed unrealized investment losses, which resulted in a 35% fall in the share price. It was then reported that the company was being investigated by the Securities and Exchange Commission as part of a securities fraud case. It transpired Riley Financial had lent one of its officers, Brian Kahn, $200 million, and Brian Kahn was now named as one of the conspirators in a securities fraud case related to John Hughes and Prophecy Asset Management. Bad news tends to come in three parts, and so, in March 2024, Riley Financial reported widening losses and a delay in filing its annual report. The cumulative effect of all this bad news was Riley Financial become one of the most shorted stocks in the USA. Last week, on the 15th of August, Bryant Riley submitted a letter to the board of directors of the company proposing to acquire all of the shares of common stock that he does not presently own for a purchase price of $7 per share. To note, Bryant Riley currently owns approximately 23% of the company's shares. So what sort of opportunity does this mess of a situation offer to an arbitrager? The methodology of this risk arbitrage deal is perfectly simple, basically a carbon copy of what we looked at last time with Mattioli Woods. Bryant is offering to acquire the company in an all-cash transaction. An arbitrager would therefore only need to take a long position in Riley Financial at the current spot price of $5.49, hold the position until the deal is complete, and then walk away with $7 in cash. The reality here isn't quite that simple. First, we need to be aware that the probability of the deal closing is very low compared to most deals. So far, there has been no confirmation as to whether Bryant has the financing in place to actually transact the deal. Second, we have no confirmation from the board of directors as to how inclined they are to the deal, or whether they think the price and terms are fair to the independent shareholders. Third, there may be regulatory concerns, especially considering the ongoing securities fraud case. And finally, if this was to go to a shareholder vote, they may vote against it. Additionally, on some deals, an arbitrager may consider the possibility of a second bidder emerging, bidding up the offer price, and improving the return characteristics. However, in this instance, it's difficult to consider who may be inclined to bid on such a company. The cumulative weight of these issues means I calculate only a 20% chance of the deal closing. It certainly is a transaction that puts the risk in risk arbitrage. However, for our own interest, let's run the numbers to see what the financial outcome of this transaction could look like for an arbitrager. If we assume a purchase price of $5.49, a holding period of 163 days, a downside price of $2.50 should the deal fail to close, and a continuation of the bad news, and a probability of closing of 20%. We can see an investor can expect an unleveraged return of 27.62%, which equates to 61.85% on an annualized basis. However, given the low probability of success and the significant downside price, the risk-adjusted return is negative 85.12%. Should the deal fail to close, an investor can expect to lose 54.42% of their capital. These figures really demonstrate the base characteristics of this deal: high risk, high reward. What if we consider a degenerate, mean stock type investor deciding to YOLO into this deal using 50% leverage? The expected return would increase to 53.01%, with an annual rate of return of 118.7%. However, the risk-adjusted return actually falls to negative 171.24%. This negative result is due to the carrying cost of debt and the requirement of paying back more in debt than the position is worth if the deal doesn't close, assuming the broker hasn't liquidated the position before that happens. So, as I mentioned at the outset, an investor with an iron will and ice running through their veins could make a significant return from this transaction. However, the odds are not favorable to a positive outcome. What do you guys think of this takeover? Let me know in the comments, and don't forget to like and follow if you found this video useful. Be aware that all the figures mentioned are at the date of my calculations and will change in line with the share price of the company, any change to the takeover price, and the duration to close. As always, this information is provided for educational purposes only. You should not consider anything in this video to be investment or financial advice, nor a recommendation or endorsement to buy or sell any financial instrument. You should always conduct your own research before considering any investment and seek independent financial advice. Thank you, and until next time, enjoy life.